Hi guys, welcome back to my channel. Kelvin here. ETF or exchange traded funds is one of the easiest and best way to invest for most people. So much so that even our Warren Buffett Koko has once said that for most people, the best thing to do is to own the S&P 500 index fund. He trusted it so much that he even asked his trustee to invest 90% of his wealth in the S&P 500 after he is gone. Then you'll be like, wow, got so good man? Sure, not all. So in this video, I will tell you everything you need to know about investing in an ETF. What exactly is an ETF? What are the benefits? Which ETF to buy? Hashtag stock tips. Also, how to buy. Before I start, I would greatly appreciate it if you can help to tap the like button because it will help out with the channel a lot. In return, I will show you a happy sheep. Alright, let's start right now. So, what is an ETF? Basically, an ETF is just a basket of stocks that track something. For example, it could be a basket of US stocks, or a basket of technology stocks, or a basket of semiconductor stocks, and so on. Think of ETF like the set meal in McDonald's, where you can buy the McLao side, McSpicy set meal. Then inside got burger, fries, drinks, or the overhyped BTS set meal. You got your nugget with purple packaging, drink with purple packaging, sauce with purple packaging. That's basically an ETF, just a basket of stocks. Next, why does Warren Buffett Koko likes index funds so much? Apparently, he likes index funds as much as the Coca-Cola he drinks every day. He even went and made a $1 million bet with the hedge fund managers that the index fund will beat their ass, and he won. So here are the benefits of investing into an ETF. First, diversification. Remember that an ETF has a lot of stocks in it? This makes the ETF super diversified. Let's say I bought into an individual stock like AMC. If that stock drops, then I will end up buying high and selling low, like a true ape from Wall Street bets. But for index fund, that one stock drop, man, there's still few hundred over stocks that are doing well. So overall, my portfolio will still be green. Here's the basic idea of investing in an ETF. You won't buy the wrong stocks if you buy everything. When you buy a stock, you are betting that the company will do well. But when you buy an ETF, you are betting that overall, the entire list will do well. For example, if you buy S&P 500 ETF, you are betting that overall, the entire US will do well. So that's the first benefit, diversification. Second, self-rebalancing. So to be eligible to join the S&P 500 ETF, you need to fulfill a few criteria. For example, it needs to have a market cap of $13.1 billion and the latest few quarters must be earning money. If the stock don't fulfill these criteria, it will be kicked out of the index, then replaced with a better stock. For example, did you know that your GameStop was in the S&P 500 last time, but it wasn't doing so well, so it got kicked out? This means the ETF will auto-rebalance itself. Bad stock will go out, good stock will come in. The benefit, low cost. An ETF has very low fee. For example, when you invest in an S&P 500 ETF like BOO, the expense ratio is only like 0.03%. That means for every $1,000 you invest in this ETF, the management only takes 30 cents, which is super duper low. I don't even know how they can afford to pay their employees. Pay with air and rainwater. But when you compare it to mutual funds or unit trusts like the Allianz Income and Growth, the expense ratio is 1.54%, which means that for every $1,000 you invest, they take a godlike of $10.54. What? By the way, don't just think that 1% difference is a small amount. When you compound it over a long period, the cost is super big. For example, if you invest $100,000 with 6% return over 30 years, with the 0.15% annual cost, you'll get $549,000. But with a slightly higher cost at 0.6%, you will lose $70,000 to the fees. I don't know about you, but that $70,000 can buy a lot of chai fan with fish already. Fourth benefit, passive investing. So whenever you invest in stocks, you need to do a lot of work, like you need to study the company, check the news, monitor the price, and so on. Unless, of course, you are an ape from Wall Street bets, then you don't need to do all this. But for all the other good, responsible investors out there, you need to do all the hard work. Meanwhile, when you invest in an ETF, it is super passive. There's nothing much for you to do. The ETF can do its own rebalancing. It is already diversified. All you need to do is just invest your money, like shut up and take my money. Then wait for 10 to 20 years for your money to grow. So simple. This saves you a lot of time, which will give you more time to do meaningful stuff, like climbing rank in LOL or playing Animal Crossing. So those were some uncut bolas about investing in an ETF. Then you'll be like, yeah, but I don't even know how to start. Right now, there's 7,000 plus ETFs in the world. How to choose? Here are a few tips. First, growth or dividend focus. When investing, you have to choose whether you want growth ETF or you want dividend ETF. For growth ETF, you usually get higher returns because the companies are still growing fast and furious. For example, Tesla and the fruit company Apple is a growth company. They are still expanding and coming up with new stuff every year. Meanwhile, on the other hand, for dividend ETF, you will get paid money periodically, but the growth is very low because the company has already matured, it can't grow quickly anymore. Like our Johnson & Johnson, it is already selling the strawberry shampoos everywhere and can't expand its market anymore. So instead of using the extra cash to grow, it will usually pay the cash to investors as dividends. An example of growth ETF is Vanguard Growth ETF or VUG. It gave about 12% annualized return. For dividend ETF, there's Vanguard High Dividend Yield ETF. The annualized return, including dividends, is about 8.6%. Personally, I feel that growth ETF is better because higher returns ma. But there's also one extra benefit. When you invest in overseas ETF, like ETFs from the US, Uncle Sam will want to tax you. In this case, he will charge you 30% withholding tax on your dividends. So if the ETF gives you $1, he will take 30 cents and will only give you 70 cents. Now, you can reduce the tax by investing in something called Ireland Domicile ETF, but I won't talk about it here. Otherwise, this video will be longer than the Titanic movie. If you want to know more, you can check out the video here. Meanwhile, on the other hand, there's no tax on capital gains. US won't tax you and Singapore also won't tax you. If you sell your ETF and earn $1,000, you get to keep that $1,000. So if you want higher returns, choose growth ETF. But if you want passive income but slightly lower returns, choose dividend ETF. Second, each ETF represents something different, and there are a lot of different ETFs, like ETFs everywhere. Let me give you a few popular kinds of ETFs. If you want the lowest risk, go for the ETF that tracks multiple countries, like IWDA. It tracks US, Japan, UK, and others. As long as we don't go and nuke each other and destroy the world, this ETF will do well. This kind of ETF has a low return, at 11% annualized return. If you only want ETFs that represent a country, you can get CSPS, which tracks the US. It gave around 15% annualized return. Or you can get STI ETF, which tracks Singapore. It gave around 6% return. If you want slightly higher reward but slightly higher risk, go for sector ETFs like the technology ETF, SSLK, gives about 25% return, or the healthcare ETF, IUHC, which gives 13% return. Finally, there's thematic ETF, basically ETFs that's based on a theme. The risk and reward is usually very high. For example, Arcade, which is an innovation ETF, gave about 34% annualized returns. Also, take note that the expense ratio for thematic ETF are usually higher because the fund manager will have to manually manage the funds. So which ETF you choose totally depends on your preference and risk appetite. If you don't know which ETF to choose, I have a pro tip for you. Go to etfdb.com/compare. It will show you the most popular ETFs, the cheapest ETFs, the best performing ETFs, and so on. Then you can try to choose from there. Next, how to buy an ETF. When you buy broccoli, you need to go to the market to buy. Same thing for ETF, you need to use a broker to buy. There are a lot of different brokers like DBS Vickers, Maybank Kim Eng, but those are usually quite expensive. They will charge you a godlike $25, which they will claim is competitive pricing. Not too sure what they are talking about here because that $25 is more than enough for you to buy 2 sets of xiaolong baos for your girlfriend or boyfriend. Instead, I would recommend using low-cost brokers like Interactive Brokers, Tiger Brokers, or Moomoo to buy. Their fee is only like $1 to $2 per order. Cheap. By the way, you need to know where are your ETFs listed. If your ETF is listed in the US market, you will need a broker that can access the US market. If you are not sure, just search in Google lor. For example, Arcade, here says New York Stock Exchange, basically the US market. If you search IWDA, here says LOM, basically the UK market. For Tiger Brokers and Moomoo, they don't have UK market. So if you want to buy ETF from the UK market, you will need to use Interactive Brokers. If you need tutorials, I've already done up all the tutorials. Nice! Finally, let's talk about what should your investing strategy be. There are 3 main strategies. Lump sum investing, where you all in your money. Dollar cost average, where you split your money and buy a bit every month or every week. Then you have timing the market, where you try to buy at the lowest point. Most people will think that they are hardcore and will try to time the market, but it always turns out that they are not hardcore. Check this out, if you can time the market perfectly, you will get the best return. But if you time the market wrongly, you will get a much lower return. So that makes timing the market a very bad strategy. The second best strategy is lump sum investing. Some people prefer to dollar cost average, like me. I prefer to slowly invest my money. just in case the market crash, then I can buy the dip. Whichever strategy you choose is totally up to you. The most important thing to remember is you need to consistently invest your money, and over the long term, you will what big. So that was how to invest in an ETF. Hopefully, this video is useful to you. Which ETF are you investing in? Let me know down below. Like, share, and subscribe as I'll be posting new videos every Monday, Wednesday, and Friday.